All right, so we had a good jobs number today that helped the market rally off of yesterday's intraday low point, continue the rally off of yesterday's intraday low point, as if this little pullback weakness we had this week never happened. Is that, the end of the story now? Is that, what can we expect from this weakness? Should we expect more weakness? Did we get other markets kind of confirming this risk appetite, or are we seeing something else that would suggest? And if and when we do get this pullback, how will it look like? And of course, we can continue to trade how we trade, and we're going to trade today again a bullish trade for our trade idea in a sector that's been really beaten up. That actually has given us some good bearish opportunities lately, but now it's kind of reversing and giving us a good bullish opportunity today. So let's go ahead and get started. Today is Friday, May the 3rd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the Market Forecast Indicator first. And you can see how the bounce back here, the short-term sentiment bounced back to kind of a bullish territory, especially on the Russell 2000. You can see we actually almost got an overbought cluster, just like that, on the Russell 2000. The near-term line got to 74, essentially. Obviously would not have had the market sentiment line like some of these other indexes, but still that the closing at the high of the day today, that means that the momentum line got to 100, which is rare. And you also see the NASDAQ composite pretty much got to 100. We're just a smidgen off of the high today. And that's why you got the 99.62. So very strong reversals in the momentum line from what were extreme lows for both of these last couple days. Of course, the near-term line for all these indexes getting back into the upper half of the chart, which is not surprising. We kind of expected that. I mentioned on Wednesday, don't expect that we'll pile on this loss. And it was an intermediate confirmation signal by definition. Just too extreme was the momentum line. Otherwise, it would have been kind of a picture perfect intermediate confirmation signal. The next day brought the near-term line down a smidgen into the reversal zone. You can see the Dow also just got barely. The NASDAQ was even closer to 20, and then the Russell never did drop below 20. And you look at the Russell here breaking above 1600, closing above that high of 1602. So that's the first time. Now remember, all the S&P is at all-time highs, but the Russell has been lagging, and that's a nice little breakout for the small cap index. So it's nice little move and a little bit of a bullish pattern. Now again, how much longer are we going to remain bullish? Remember, we haven't had this intermediate pullback yet, so. Doesn't mean that we can't be bullish for another month or two, but the longer we go, we're 3+ months, then the more likely that the pullback is going to be. I mean, like I said before, a pullback right now to 2807 would be a significant drop. I mean, that's essentially where the 200-day moving average almost is. That'd be a significant drop, and all that would be is a 23% retracement of what we've rallied so far. So, and this continues to move higher if this high point keeps the high point keeps moving higher. So, at some point in time, we'll get this pullback. And as I mentioned, it's not going to be this week, obviously, and probably not going to be next week either. But these near-term runs, as we get them, and as we start getting these red flags of oversold momentum lines and extremely oversold momentum lines and near-term lines that are that run up and only give us like a few days. So it's really important to see where this near-term line gets now. Now that it's above 50, because again, we're looking for signs that this mature intermediate run is close to ending. Now remember, we don't go from strong bullish posture to strong bearish posture. So I'm not saying that we're going to tank here anytime soon, but we're going to run out of gas, right? And so from a technical perspective, what I'm going to be watching for is that blue line to get above 80, like it did over here, and then stay above 50, stay in the upper half of the chart for that 7 to 12 days, probably closer to 7, like this one was 7 days. See, over here, we did get above 80, but we only had 4 days. We get more jumps like this up above 50, where it's only a couple of days and maybe not even getting above 80. Red flags, right? That's a red flag on a near-term basis. So we'll keep our eyes on this early next week to see how far up we go, whether we get up to new highs on the S&P or not. So from a intermarket standpoint, the small cap outperformance was a very positive sign that we haven't had for a while. We haven't, initially we had small caps outperforming here, but then, the Russell went flat during this period of time while the S&P kept grinding higher. And then now, it's good to see from a risk appetite perspective, small caps kind of breaking out and leading higher again. All right, before we look at some other charts, a reminder here to subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of the screen and hit that red subscribe button that pops out. Or if you're watching on the desktop, there's a red subscribe button down below the video. Either way, that will notify you when these videos are posted on YouTube. Also, while you're there, click the thumbs up icon. That tells me two things. Number one, you got something out of the video today. Number two, you want us to do it again on Monday. So it's the way that you tell us when we put a piece of content out that you want us to do it again is by clicking that like button or the heart or whatever. That lets us know that you liked it, that you appreciated it, that you want us to do it again. Very quick. You can do it right now while you're watching. Also down there, comment. What did you get out of the video today? Did anything stand out to you? Comment on that down below. Also, join our Daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click up on that link to subscribe. Follow me on Twitter for more content in between the videos from day to day. And then join our Market Outlook community that we created on Facebook. Also, if you're watching this on our blog, there's a lot of things here. One thing to keep in mind, Brandon's gone on Monday. He's at the he's on his way out to the Berkshire Hathaway shareholders meeting in Omaha. So in place of his classes on Monday, he recorded this particular session here relating to his top-down trend trading class that he does on Monday. So for premium Market Scholar subscribers, you should have access to that. You should be able to check that out. Again, that takes the place of his normally scheduled classes he has on Monday, and then we're back to our normal schedule, as you can see here on Tuesday. Also, here's an easy way to also subscribe to our Market Outlook email list. Remember, you get 4 watch lists on that email on the weekends, so make sure you get those watch lists, and you have to scroll down on the email to the bottom to see those. And then finally, if you see here, these are share buttons. You can share this post on Twitter, on Facebook, or on LinkedIn. What I'm going to do here is we're going to see if we can get this number up above 100. If we do get it above 100, then what I'll do is I will post kind of an update to some recent Market Outlook trades that we've done in my videos, at least over the past week or a couple of weeks here. I'll post it in the blog for anybody who is subscribed to our site. Remember, you can subscribe to our site for free right here, and then I'll just kind of post that on there again if we can get this number up above 0. But that means either sharing it on Facebook or on Twitter or on LinkedIn there. So now we look at the long-term charts and look at that long upper shadow that we had today. So that's the last couple of days of declines, and we bounced off of those. Long upper shadows are not as bearish as long lower shadows, are not as bearish as long upper shadows. Now that one didn't play out into a reversal, but those are, that's the type of pattern. You can see the long upper shadows can be bearish. But long lower shadows, they're still bearish, not as bearish. So we'll kind of keep our eyes on that. From a Hakinyashi standpoint, you can see a nice good bullish candle, a smidgen of a lower shadow here, but very, very small. Next week, we run the risk next week, depending upon how much we move higher, we run the risk of getting a transition candle. So we'll see that here in a minute when we look at the intraday chart. But that's going to be a key again. Not that we'll tank next week, not that we'll tank at all for that matter. But like I said, a move down to 2,800. By the time we do that, that will just be just a 23% retracement, and it will be right where the 200-day moving average is. So it will be uncomfortable for some people, and there will be a lot of chatter about, oh no, we're approaching the 200-day moving average again if we do that. But it will simply just be a shallow Fibonacci retracement, and it's only as big as it is because of how big the rally has been. If we take a look at the 3 green arrow chart, you can see we still got the 1 green arrow on the moving average. The MACD is not green yet. The stochastics is still red, and in fact we just barely dropped below 75 today. But again, barring a significant decline on Monday or Tuesday, Most likely that near term, that stochastic is going to turn up a little bit. You see we got the 74. You get the red arrow and it drops below 75. You can see we're back above the 8-day moving average. So again, puts it in context how bearish we were the last couple of days, that we were basically just testing the 17-day moving average. The MACD is still easily positive. Stochastic still easily in the upper half of the chart. So again, we're not threatening on any declines anytime soon. Doesn't mean that we can't grind or slow down like we did, like say over here. But it also doesn't mean that we have to do this kind of a decline, a sharp decline. At some point in time, you'll start to see this MACD shrink towards zero as these lines converge together, and then you get more of that extended intermediate pullback here that we're expecting. Now we look at the intraday chart, and you can see again, we had this old breakout here, and then we kind of, this been a little bit more volatile. Instead of staying sideways like we've been, on these other breakouts where we can just kind of go sideways for a while, we had a dip. We bounced back up into this little range. We got this high up here a couple days ago. We had a bigger dip, and now just like that, we're right back up here where we broke out to on Monday. So there's some more volatility this week, but the reality is, we ended up, towards the higher end. We closed above last week's high. We ended up towards the high of this week. We did get a slightly higher low point. We did get a slightly higher high point. And obviously today's high and low, we gapped up above yesterday's high and held it this morning, and then rallied up to a new and closed on some of these indexes up there. You see the volume a lot less than what we saw yesterday. And again, if I were to go back really quickly to the Hakinyashi candlestick here, on the long-term chart, and then go to Hakinyashi here, and then SPY over here, you can see again the close today was at 293 exactly. The open here was at where's the open? At 289.68. So 293 minus 289.68 divided by 2, added 289.68. Is that right? 289.68, the open? Yep. So that means the Hakinyashi open for next week will be at 291.34. So let's put that on here. 291.34. And you can see that's right there. There's where the Hakinyashi opened. Remember, now this is going to move up next week too, Monday, to this low point. So we're going to move up about 0.8%, which will move this up to almost 291 essentially. So these two lines will pretty much be sitting right on top of each other, and you can see we're not threatening necessarily, but it's only a few points away. It'll be very easy for us to threaten that line, to threaten that Hakinyashi open, and again because we'll start depending upon where we start off. If we start off up here, then that would be your upper shadow. And then if we trade anywhere below that purple line, then you'd have a lower shadow down there, and that would be your transition candle, and we would expect more weakness to occur the following week. So we'll see if that's what happens next week or not, but that's what we'd be looking for, right? Same thing with the near-term line. Those are kind of things we're watching to see if and when we get more of that prolonged weakness that lasts beyond just a day and a half. Like we had essentially, well, not even a full day really, that we had right here. Right, you look at today's volume and trading range. So the trading range was over 3 points again. So yesterday's was relatively high, over 3 points. The day before that was over 3 points. So we're getting multiple days of 3-point ranges. And remember too, today's range includes a gap between 291.18 and 291.30, so about a tenth of a point that you add on to there. So just very similar range to what we've had the last few days. It's above the average. That average is very low, and the volume was less today. It was higher earlier this week, and it's been less today, but still right there at 56 million. So we put those numbers in context. 3 points is right here, so it's above the line, but it's not bearish, right? Bearish is more in this 4 to 5 range. Obviously, if we got 6+, that would be extreme. We'd buy that sucker like there's no tomorrow. But if we get consistent days of 4 or 5 point ranges, that's bearish. That's sustainable. And volume in the 100 to 125 million. Today we're at 56 million. So we're not threatening any kind of significant declines. And like I said, more like this type of not this type of intermediate pullback, which actually brought the market sentiment line below 50, but more of this type of intermediate pullback, which only brings the intermediate line below 50, but not to oversold levels. Finally, let's look at the volatility. You can see volatility has dropped back down below 13, and you can see it's back down to the midpoint of this bullish range. So as I mentioned before, I believe last week, we've been, we're threatening here. The volatility index has been, kind of threatening with below 85, but we're kind of in this mode where we probably need to get a move up towards 1. We'll probably hit 1 before we drop below 80%. And then, that would be our intermediate pullback again, similar to, so right here. Right, we'll get up to 1, and then we drop down and start threatening the 80 level. So we're kind of in this mode here, where we are trading in the bullish zone and a little bit below that midpoint of 85%. But now we're probably going to get, probably a short term. It didn't last very long. It took like a week and a half here, but it get, up to that 1%. It got up almost to 20. In this case, got up to 19.61. And then, it's been a couple weeks pulling back down, and now we're back into that bearish mode. So this is the type of pattern I'm expecting that we'll get sometime here in the near future, whether it's next week or whether the week after. Most likely would at the very least, at the very soonest, start with some kind of transition next week, and then more of a weakness, bearishness the week after. But again, that would be the soonest. That's not necessarily even the highest probability outcome either. We can still kind of grind for a while to the upside towards that 3,000 area on the S&P, which can act like a magnet and try to sucker in a lot of cash here late in the rally before we get that pullback and kind of shake out those weak hands. All right, so before we transition into talking about what's driving this price action and from an intermarket relationship and sector rotation, as well as our trade idea of the day, let's now I want to hear from you. Let's vote on what you think about this market outlook that we just came out with and our expectations here. Do you agree or disagree with that? Click that link that's popping up there in the top right corner of your screen. It opens up a poll, then hit either agree or disagree. If you click disagree, comment down below on what you see that would suggest otherwise from what we just came up with during our little our daily routine, our market outlook routine here. All right, now let's talk about what's driving the price action today. And you can see a lot of the weakness we actually had over the past few days was I think attributed mostly to a weakness in crude oil that we had. You can see crude oil started off that weakness last week. We talked about that in last Friday's video. But we were, in this case, we had a 4% jump higher, and that brought stocks up. But from that point down, crude oil dropped from a 4% gain in these, from this starting point down to a 2% loss, just like that by the beginning of Friday. And then we held most of that loss by the end of the day. You notice how generally this has been very correlated, but stocks didn't fall along with that. They actually held up. In fact, small cap stocks finished pretty strong. But then we fast forward, we had a nice little rally, and crude oil started off the week, and stocks kind of bounced up too, but to lower highs, where crude oil went to higher highs, so a little bit of divergence. But then we went from a 0.5% gain in crude oil to a 4% loss in a matter of a couple of days, and a lot of that right after the FOMC meeting here. A lot of those losses, and of course, stocks came down with it this time, and so a lot of that, a lot of our weakness here, is reflected in crude oil being this higher beta risk appetite play asset class. And I don't think it gets talked about a lot, especially considering the weakness we had coming into the week already in crude that was not reflected in equities, which is a little bit of a divergence from recent because they're so highly correlated right now. If I were to, take a look at the correlations here for and just look at correlations of the S&P or the crude oil to the S&P 500 over the past 3 months, a rolling 3-month window, then you can see the correlation is close to 100%, 95% there. So I don't know why we're getting a little bit of a gap there, but 95% correlation. So That's a significant correlation. Like I said, we saw that weakness on Friday that was not reflected, and a little bit of a breakdown there that was not reflected in equities. And you can see a continued drop yesterday to new lows. Again, not reflected in equities. We weren't that bearish. We hadn't dropped that much. And even today's bounce, as bullish as it was in the Russell, not reflected in crude oil again. So you're getting a little bit of a divergence here in the performance, which if we're going to maintain this correlation, which means most likely equities will start that pullback too. You can see the crude oil has already pulled back to its 23% retracement. And like I said, equity still has some room to go to get to just that level, much less the top of the actual Fibonacci retracement zone, which is the 38% level, which is more normal. But that would even be that much more of a significant decline for the S&P 500. But like I said, one positive that's come out of this week when we look at the asset class comparison, and let's just zoom in here just on this week right here, and we'll go 10 minutes. You can see small cap crude oil started strong, pulled back, and that brought everything down with it. But you can see small cap in this bounce here from these lows, small cap stocks and emerging market stocks really took off, as well as developed markets too. But internationals and those in the dollar, which had a little bit of a bounce coming out of the FOMC, pulled back, and actually that breakout, which last week we said, I'm not really necessarily buying that breakout move in the dollar. Well, so far that breakout hasn't held. Now this is a little bit of a return move. We'll see if we bounce off of this 50 and then continue higher, right? Get back above 98, and there we go. But as of right now, it's not looking very promising that the dollar is going to hold that breakout. And if that ends up being a fake out, we come back below the 50 here, this 97, 97.20 or so. If we come back below that next week, then that's a bearish pattern. When you get a false breakout, resistance breakout, that's a pretty bearish pattern, and you would expect weakness going forward here in the dollar. Now that doesn't mean the equities will, U.S. equities. In fact, that's might be a decent sign for equities, but it would definitely be a lot better for international equities, which have been underperformers, right? Especially the emerging markets. When we look at the 12 grid and pull up this, watch this over here for the foreign markets, they've been struggling, right? The emerging markets. So here, let me make sure let me get this on the 3-month. Yeah, this is just 2 weeks. So let me change this to 63 days and then come over here to 63 days and hit OK here. So when we look at the 3-month returns, not surprising, these are very high betas, but Turkey and Brazil, but you see Indonesia, Poland, South Korea, Thailand, Argentina, Russia. These are all emerging markets. They've been the biggest underperformers. Up here you have Taiwan, you have the Netherlands, you have India, which has been the one bright spot in they've held up its gains. But then you see Switzerland, France, Italy, Germany. So it's all developed markets. Emerging markets have been lagging, and kind of all of them. The S&P has been doing pretty well against most of these major areas. There's China, Canada, Australia. There's the UK right there, all lagging behind the S&P. So if the dollar drops, expect the S&P in this list to come down here towards the bottom. And remember, that's a pretty big number as it is, 8.83% for the dollar. If you remember on that rate of change chart here, that's a relatively large number still as it is. So that's, again, another sign that if we don't get weakness here in the short term, we at least significantly slow down. I brought up how rare in today's technical analysis class. For those are premium subscribers, make sure you go check that out. But we brought up how rare it is to go from this level, where the blue line is, on a 3-month return to that level in that short amount of time. So we looked in the past at some prior instances of that happening, and there was some interesting data points to see what happens afterwards. And so, but like I said, as it is, if you look at where my line, my horizontal line is, that's still a pretty high level for recent history for a 3-month return. So, we don't have to go down for that number to go down, but at least we start slowing down a lot more than we've had to get to this point. All right, now we take a look at the sector rotation. You can see again over here on the left, the high numbers that we have that are outpacing the market are all these cyclical sectors: technology, discretionary, communication services, and you also have industrials up here. On the low end of the spectrum, you have two negatives, and that's this energy sector here and the healthcare sector, both below. At least until today, the healthcare is actually looking pretty decent today, but both of those have falling moving averages and were below it until then. The materials also bouncing up from below its moving average, and some things are looking a little bit better, a little bit more bounce than others. Technology didn't bounce as much. In fact, if we just look at just today, the biggest gainers were materials, industrials, and then discretionary and communication services. Technology lag or kind of matching the market, and you see these safe haven, interest rate sensitive areas first, but safe haven areas all lagging behind, including healthcare. You see the long term, the 10-year note. We were down today about two basis points, so almost 1%. And you can see how that the trend is. It's not bearish. You can see we got some Hakenyashi, some transition here. So we're not necessarily. We've had this little bit of a bullish bounce, but the transition suggests maybe that bullish bounce might be over with, right? Similar to something like we had over here. So we want to keep an eye on how the yield does around this 200-day this 50-day moving average. Because if we bounce down and continue to go down, that's really going to pressure these areas, which had been some outperformers, but now they're going to really start lagging behind and get to where some of these like healthcare will bounce. I would expect healthcare to bounce, and I would also expect energy and materials to bounce if the dollar, because a falling yield would also be bearish for the dollar, and we expect those underperforming areas. Industrials has already started to kind of jump off again, but we haven't seen the same rally to the same extent in materials, and definitely not to the same extent in energy yet. All right, so that brings us to our trade idea of the day, and I want to take a look at a stock in that healthcare sector that's starting to improve a little bit here, and that's Bristol Myers. Look at the nice little breakout it had today, getting up above 47.5. We had lots of clusters, not just on the daily chart, but you can see a couple weekly clusters here, and look at that breakout on the weekly. So nice, good breakout move. Near-term line getting up over the momentum line on the weekly basis, breaking out to a high level. Very good sign for on a daily chart. You can see, the daily chart. You can see the near-term, the momentum, the moving average, hasn't turned up yet. But considering, unless we have a big drop on Monday, that's probably going to turn up on Monday. So it'll turn green on Tuesday, and then by tomorrow, again, barring a big drop on Monday, we'll probably get the intermediate line crossing above 52. So we'll get dark green shading on Monday and probably the dark green line on the moving average on Tuesday. And there's your bullish combination, right? Especially when you combine that with 3 green arrows, which is what we got here yesterday, and really validated today with a spike in volume, or close to a spike in volume. Came very, very close to a spike there. And then finally, you look at the long term, not finally, but another chart here. Look at the long term chart. You can see when you get above the 50 like this, and there's a gap between the two, that generally leads to us filling that gap. So up to about this 51 3/4 area. If you take a look at the Bollinger Bands, there's another reason why that area is significant. 51 3/4 right in this area, that's where your biggest volume node is. So we have a chance to move up a little bit more into this area before we run up into volume. There's going to be some significant volume resistance. Break out above this 54 level, and then we have a move all the way up to the upside, and very little volume to hold you back. But to get to that level, it's not going to be, to get to that breakout, if it ever occurs, it's not going to be easy to get there, because you got a lot of headwinds to push through in terms of volume. But at least you have a lot of bullish patterns. Again, on the DMI, you can see that we broke above 25 on the positive. The negative was already below 20, so that's a good pattern there from a bullish perspective. So now, because of that headwind, and that's not too far away, I would say, they buy a call option. We've got an opportunity to be bullish here for a while, but you got all that resistance just barely right up above us. So if we were breaking out above 54, we'd buy a call option, no questions asked, because we'd have a good opportunity for some return. for a while, and very little volume to hold you back. So it could be a pretty decently speedy return to the upside. But until then, not going to be speedy. At least we wouldn't expect it to be. Of course, anything can happen, but you wouldn't expect it to be speedy with all that resistance ahead. So, as long as it can stay up above this, this node that we had here down below, then again, that's where we can say, okay, let me just sell this 48 put. We'll buy the 46 put. It's not exactly, below 40 in the delta. It's a little bit wide of a spread. So I'll have to get filled in right around this 55, 56 area. And you can see this line is where my break even would be. So essentially, we'd have to hold the breakout gap that we had, what could be called a runaway gap, that first gap that you have in a trend. Then you have some in the middle, and you have kind of one at the end. Maybe the one at the end is called the runaway. But that's kind of how gaps are. You get gaps at the beginning, gaps at the end, and a few in the middle. This obviously may be the first gap on the beginning of an upward trend. As long as we hold that gap, then we're fine, right? We're able to be able to get most of that return. Remember, I'm willing to give up $56 in order to try to get that, and try to get a good, decent probability here. So that's our trade of the day, trying to get back into this healthcare sector that's been beaten up, into a stock in particular in that sector that's breaking out today with some really good bullish patterns. All right, well, that wraps us up for today. As always, thank you very much for watching. Now I want to hear from you. So use that link popping out there. Let's go to our forums, open up any new thread that you want in our Market Outlook forum with any questions or comments that you have on anything I discussed in today's video, or on anything I didn't discuss in today's video. If you want to get a good topic, a conversation going among people that watch these videos like you do, then open up any new thread in that Market Outlook. Remember, you have to subscribe to our site, but you can do that for free. And also, like I said, if we get above the 100 shares on the blog post, then I'll send out that blog post with an update on recent Market Outlook trades to anybody subscribed to the site. Remember, you can do that for free. I showed you how to do that earlier, how to subscribe. And you get, like I said, you can also participate in the forums for free as well. Not in the class forums. Those are reserved for premium subscribers, but at least in our Market Outlook forums. As always, thank you very, very much for watching. Have a great rest of your weekend, everybody. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on the video. Follow me on Twitter for more content, and join our community on Facebook, as well as on marketscholars.com. Have a great rest of your weekend, and we'll see you all on Monday.